You know that feeling when someone shows up for you just when you need it most? That's what Uber is all about. Not just a ride or dinner at your door. It's how Uber helps you show up for the moments that matter. Because showing up can turn a tough day around or make a good one even better. Whatever it is, big or small, Uber is on the way. So you can be on yours. Uber, on our way.
Reality radio for a really great future. We're talking real money.
Do you have 6 minutes to spare? Do you have an extra 6 minutes laying around? Well, if you do, and you're like most Americans, you too can apparently be a stock picker, because that's all the time most people spend trying to pick individual stocks. What? Hi, everybody. I'm Don McDonald. This is Talking Real Money, and over there, taking a brief break from his many vacations, is the inimitable and actually working Tom Cock for a change. He'll be back on vacation. He'll be back on vacation for the rest of the summer.
I like to break things up a little bit.
A bit.
Come into the office.
I like take my gear along, but no.
I wouldn't know how to do that.
Only time I didn't take my gear was when I had to go to the hospital. That when I didn't take my gear for that.
And that was an outrage. I'm
sorry.
Call the hospital and say, get that stuff in there.
Welcome to the program. And what are we talking about? Well, it turns out that we're not big fans of buying individual stocks.
We can talk more about that, too.
We'll get to that.
Sure,
but it turns out that you guys don't put a lot of effort into trying to pick great investments. It's not like you're breaking a sweat even if you're only taking 6 minutes to pick a stock, Don.
Yeah, a new study out by finance professors Tomas Laridis and Jeffrey Wergler at New York University Stern School of Business. I'm assuming that's not the Howard Stern School of Business, right?
No, that's a different Stern. By the way, my daughter is yes, she's graduated from NYU, but not Stern School.
I'm so
NYU.
proud of her.
Yeah.
I knew her when. That's great.
She got her master's.
Wonderful. The bulk of, by the way, according to this study, of that already short, I love that, already short research time is devoted to perusing a price chart of the stock's recent performance, and often just the current day's trading session. Most of the time is spent looking
just
at the
to
recent
see what
price.
it's doing today.
Yeah. I'm trying not to laugh. 6 minutes applies to the median investor. So, and this is from the Wall Street Journal from our friend Mark Hulbert. So not all investors are impulsive. A minority of investors do rather deep dives into trading a stock, says Wergler, but a much larger pool of investors spends virtually no time at all researching a stock before buying it. Now, as if the 6 minutes wasn't bad enough, they estimate that before buying a stock, the median investor spends 1% of the time. That would be 6 seconds, by the way, for those of you playing along at home, examining its risk statistics, looking at what could go wrong.
What are the risk statistics they're looking at?
Well,
standard
company
deviation?
earnings, dividends, fundamentals, like the real guts of the company. Almost nobody spends any time on that.
Where do you find those things?
73% of them. 73% look back at 1 day or less of price to determine.
There's the underlying message here is really the gist of our humanity. And you can see it in the leadership of America right now.
It's the gut call.
The gut call. We believe that our instincts are somehow valuable, that we can just determine something by just thinking about it for a moment, that we just inherently know what's good and what's bad.
It always reminds me of the people that go to the track and look at the horses in the one. I really like the blue on number 4. I like that color.
Gosh, in Colorado when we were young, my wife and I used to go down to the dog track. There wasn't a horse track; there was a dog race, and she would pick the dogs based on how they looked,
right,
or whether or not they went to the bathroom before the race.
Are they nervous?
Yeah,
good. Okay, this really isn't funny, but it is kind of. I mean, it's laughable. It's laughable. You could say that, right? I mean, the fact that people spend so little time and don't do much research. And we already know, and this is in the article from Mark Hulbert, since picking stocks that on average will beat the market is notoriously difficult, even for Wall Street managers whose full-time job is to select such stocks, it would be going too far to predict that individuals on average would beat the market if they spent more time researching stocks before making a trade. Because what he's saying is, even if you did spend 60 hours instead of 6 minutes, the likelihood is small that you're going to do better than the index.
The reality is that those who spend 60 hours times 60 people researching stocks for hedge funds and mutual funds and the like, in aggregate, their performance is no better than what you would expect from sheer unadulterated flipping of coins.
Yeah. And I run into this all the time, whether I'm getting my hair cut, whether I'm refereeing soccer. People ask me because they know I'm in this business. They say, I just bought blank. What do you think? And I'd look at them like, well, what do you mean? Isn't that a good company? Well, maybe. I have no idea because we don't follow individual companies and we would not recommend you buy individual stocks. So let's talk about why people buy them anyway. What's the biggest reason why?
To try to beat the market.
Yeah, exactly. You're thinking this is going to do better.
I'm going to pick the best ones.
Yeah.
So that I don't have to own all of those mediocre or bad ones. I don't want to own the bad ones. Just give me the good ones.
Average doesn't get me to where I want to get you. And I'm going to disagree completely that it will get you there if you save something.
No, now wait. Hold on. It'll get you to a reasonable place. But that's not where a lot of people want to be. A lot of people want to be in the place where John Hamm's neighbors are in Your Friends and Neighbors.
Yeah, exactly. But that doesn't... The odds of that are so stacked against you, as you just pointed out, because
hope springs eternal with us. Little,
Well, you might run around the neighborhood and see what you can break into because you might do better with that. Then it might be better, as Mr. Hams found out.
Get me a nice Liechtenstein.
Yeah, I love that piece. But you're buying them. I think there's an aspect of that, but also the excitement that I now own pony number 4, right? I mean, look at this go around the track and I'm watching it every day and it's exciting. That's one. Somebody wrote recently that the other reason they like using individual stocks instead of funds is there's no fee.
Excuse me?
There's no
management fee.
There's no cost to operation of your individual stocks.
Well, yeah, but there are transaction costs, and if you're moving in and out, those transaction costs, even if you're just dealing with the spreads on stocks or ETFs,
I was going to get to that. Yes,
you're spending a lot of money.
And how many do you need to buy to be diversified? Which apparently you don't care about because you're buying individual stocks. You don't want.
But you see, that's the point. Those who buy individual stocks don't want to be diversified. Diversification is their enemy,
right? Because
the more diversified you are, the more your return resembles the mean, the median, the averages.
And I'm not average.
I don't want to be average.
I'm above average.
I'm above average.
Above
I'm
average
smarter.
driver. I'm above average looking. I'm above average. You know what? So,
and it's funny because we just recently had the retirement of Warren Buffett, or the announcement of it.
Yes, I was getting to that.
People are thinking, how can you think that you're going to do a better job researching companies than the people Warren Buffett, and he doesn't do it just on his own, pays a bloody fortune to research.
And by the way, they asked him how long he looks at a typical company before buying it. How many days? Years?
4 minutes? 5 minutes?
Years. He doesn't just walk in. I mean, he makes some deals snap like he did with Goldman Sachs in 2008 because they're going to give him 10% of his money. Yeah, sure. But when it comes to researching companies, days and decades of data, he's also a long-term holder. And by the way, any comparison between you and Warren Buffett is not a good one because he actually gets in and looks at the operation of the company. I doubt Amazon's going to invite you in to figure out how to do their shipping better.
Yeah, I mean, he said the company that made him the most money in his entire career was Apple,
which he didn't want to buy for a long time.
Right, but here's the thing: he and Tim Cook are on a first name, having dinner together, hanging out at each other's houses basis.
You don't think you get that if you buy a few shares of Apple?
Honest to God,
nobody supports Apple more than you do.
I don't think I got a note from Tim when I sent him an email.
That's right, you did.
I got a note.
That's right.
I got a note back. That was the extent of my time with Tim.
He didn't give you any insider trading tips or anything?
He gave me nothing. Nothing. He didn't even try to sell me the stock.
Okay.
Although they do keep trying to sell me equipment.
Well,
and
you are a regular buyer. You're a regular buyer. Okay, so no fees. I mean, the other one that I read when I look at people buying individual stocks is I have control. Whereas if I give the money to a manager, I've got no control. I don't have. You
have no more control over the investment than you do over your mutual fund or ETF. Do you think that Apple is going to bend to your will? Or even some of the small company stocks, they're not gonna.
No, they're not. The other one is, and this one you could see a little bit. Truly, I think it's the tax dog wagging the tail, tax tail wagging the dog.
I can control
tax management. I can manage my taxes better than I can. And by the way, now with exchange traded funds, they're pretty doggone tax efficient with the way they manage internally. So, but here are some of the reasons I think it's tragic. Number one, diversification. And we know this looking back. We know this from guys who've won Nobel Prizes. That's basically that and cost is your only friends on Wall Street. Mm-hmm. The rest of it is gambling. If you buy individual stocks, you time markets. Diversification is short-term stock
playing is a zero-sum game. It's a zero-sum game. Buying them and holding them like Buffett did for 5, 10, 15, 20, 25, 30, 35, 40 years.
5 decades, yeah.
Yeah, that is investing. Absolute investing. But you can't do it the way he does it, but you can do it a similar way. You buy yourself a portfolio through an ETF or a mutual fund.
If you own individual stocks, guess what? You got to pay attention. And you got to manage the money. You got to be watching what's going on with companies, right?
Okay. Let me take exception with that a little bit because all you're going to be doing...
You're going to be buying high and selling low.
You can watch, but what just happened doesn't tell you anything about what's going to happen in the next second. So the watching is a waste of time. So not only are you're setting yourself up for a likely short-term failure, you are also wasting the literal most precious resource you have. The only resource you have that is truly finite is your time. You are going, people worry about running out of money. No, you may not run out of money. You probably won't run out of money, but I guarantee you're going to run out of life.
It's going to happen to all of us.
You're going to run out.
Here's the other one.
Unless I can convince ChatGPT to suck all my thoughts into the system so that
if you do, let me know ahead of time, would you?
Yeah,
because I'd really like to know. Here's the other one that I think for most people at individual firms, it plays into being an investor in general, but especially at individual companies, and that is the idea that you can keep your emotions in check when various things happen to these companies, which they will happen, right? A lot. And you won't see it coming. And when it does, you'll think, oh, gosh, that was a mistake. Or what do I do now?
Yeah. Stoicism is easy to claim and impossible to pull off. You're
Good way to put it.
You're going to get emotional. Guarantee it.
So
at some point.
So while reading this, I will admit when I read this piece from Mark Hulbert, who has done a lot of research on individual investor behavior, I was not surprised in any way.
No.
Because the people I run into, by the way, here in the Seattle area, guess what the biggest shares of whatever companies people own?
Oh, gee, I don't know that I can guess this, but let me go out on a limb and say,
please.
I don't know, Amazon, Microsoft, Boeing,
Starbucks, Costco.
Costco.
I used to laugh and say, imagine if Bill Gates and Paul Allen had decided to stay in, do you remember where they started the company? You don't.
I don't know,
Albuquerque.
Oh, did they start in Albuquerque?
Yeah. Guess what would have been more famous than that TV show that was based there? Microsoft. But imagine how few people in Seattle would own Microsoft. A lot fewer. People have this ridiculous affinity, like, well, it's right there. It's a great company. Just because you drive by it every day.
There.
Yeah.
My friends work
this is
there.
a bunch of nonsense. So,
Or
again,
I work there. I work there,
yeah.
therefore I know.
Oh, I trust it. I know it. I trust it. So, again, I was not surprised to read this, but I find it tragic that people, A, own individual companies, and B, the way they make those decisions. I think this is very sad. And pick blue, by the way, instead of gray next time. That would be my suggestion. At either the pony track or the dog track.
Blue instead of gray?
Because I said
this
that's
the
how
Civil
people
War?
that's how people decided on
Oh,
which
the
pony.
only thing, I was trying to come up with
follow.
something that was blue and gray, and I'm going, what is blue and gray? Are we betting on the
Silver
Civil
and black?
War?
Is that better?
I know who won.
Then you're going to be very successful.
Yeah,
better.
I guess so. Do you have questions?
I've got a
Now,
lot, so I'm going to do
these were
3.
sent in at talkingrealmoney.com.
So keep them coming. Love it. Mike writes us from Seattle. Hi, Mike. Please advise me of things I should consider in making a decision on whether to move my rollover 401k that has been 100% converted to Roth 401k. Now, that suggests somehow it was done while you were working, which I didn't even...
You can do that. Yes.
I've never considered
that.
Yes,
you can.
Okay.
It's not always allowed, but it depends on the custodian.
Yeah. Okay. So it's all Roth 401k and rolling it over to a Roth IRA. I'm 67. Pension covers expenses. It's $1.6 million in addition to the $1.3 million in another Roth IRA. Avoiding RMDs. Please send me. So he's kind of asking, what do I do with it? I mean, so that sounds like it's going to be $3 million all in Roth.
Which is great.
Yeah, it's awesome. So the question is, enable me to use exchange traded funds, for example.
Okay. We don't have any information on where it is now, correct?
No, it doesn't say where he's rolling his Roth 401k to his Roth IRA. Okay. So you have $3 million in a Roth IRA. The short answer is, I don't think I'd want to put it in one fund.
No. It needs a... Okay, we are back to that. We are back to that message that we share, and it sounds self-serving, but it's really not. All of us who save and invest will reach a point in our life where it really makes sense to get help. Yeah. You could do it on your own, but you're leaving a lot of possibilities and potential problems to the future and to just pure luck. So this portfolio should probably consist of 5 to 12 different ETFs.
Exactly.
All geared specifically to your situation, how much income you need them to generate, and how comfortable you are with volatility. And your cost should be very, very low with a good advisor, because you're up there in the rarefied air of 7 figures.
Yeah,
and you got to have an advisor. I'm sorry, whether it's us or somebody else, but you've got to make sure they're 100% fiduciary, because you could get killed on this. You could get absolutely destroyed
if you went to the wrong
advisor.
Oh my goodness!
Oh my.
You could be annuitized, you could be high expense, et cetera. So no, this could be making some bad decisions. Yeah, and part 2 of that is he slightly alluded to it. Mike did, that his expenses are covered by his pensions. That's great. So the plan.
So now we're getting into some charitable planning.
But this still gets back to the thing. We always want to get to the dessert first. You got to build the plan first, then you're going to build that portfolio of the 5 to 12 ETFs with professional help. Yeah. Okay. Gerald writes
us. And manage it. And the trick from that point forward is now managing it, managing the distributions, managing the there's no taxes on a Roth. But managing the distributions and then figuring out where that money is going to go and to whom, and estate plans. There's got to be some sort of estate planning done on an amount that large. Yeah, it's work. Anyway, go ahead.
Gerald from Puyallup says, I'm 71, rolling over my IRA to a Roth for the last 6 years, and now I have a balance of $660,000 in my IRA and $586,000 in my Roth, which I think is great, by the way, to have sort of different pots, if you will.
Split.
Yeah. My question is, if I were to roll over the $500K from my IRA to the Roth, take the $100 from the Roth to pay the taxes, leaving $160K plus to draw on for 5 years, when I'm required to take my RMD. I understand this will affect my Medicare premiums. Yes, it will, because this will just be income.
Yep.
My question is this would be smart and advisable or not? No, I don't think so. And to pay the money from your Roth?
No, that's horrible, because now you're giving up tax-free growth on that money for many, many years to come.
Yeah.
That lost opportunity cost is huge, or potentially huge, could be huge. No. You're nicely split. Why?
Yeah, I know people get this Roth conversion thing like you got to do it, right?
And the other thing is that we so hate RMDs, but we forget that that's a very small price we're paying in the future for all of that tax-deferred growth and that tax deduction we got when that money went into the account when we were higher earners, probably. So just take the win.
Yeah,
you did
get
great.
over it. Yep, you're 71. Take the money when you need to, et cetera. All right, very quick last question from Monty. Hi, Don and Tom. Love the podcast. Listen to it on my commute. Definitely changed how I invest. My current employer a few years ago set up my 401k with Fidelity, picked a retirement date fund, and said it's good enough for now. The fund I picked was the Fidelity Freedom Blend 2040 commingled pool class T. A lot of words there.
Hold on, you're going to have to give me. Did he give you a symbol?
No.
Okay, give me the name again.
Fidelity Freedom Blend 2040. Freedom. But the question is about the commingled part. It's not a regular Fidelity Freedom Index. It's a commingled fund, according to Fidelity's info page, investing primarily in active underlying building blocks, utilizing active asset allocation. This active approach to target date investing is designed for clients who are looking to outperform the benchmark. Oh, of course. They're looking to. And
what is wrong with Fidelity? What is wrong with you guys?
From where they came, that's where they came from. You know that. They were the active, fun people of the whatever, decades. So because he was asking what about this versus the free portfolio we give you at Talking Real Money of the
all right, I'm pulling it up. I'm pulling this thing up.
Et cetera.
Expense ratio, 50 basis points, 0.5%.
Yeah.
The portfolio is very growthy. It leans more growth than other target products. So it's expensive and it's more growth oriented, and it is let's see what is in that portfolio.
But who are you commingling it with? No, it's a joke. That just means that they're pooling it with other people.
Yeah, they're using Fidelity actively managed funds.
Exactly.
They're using Fidelity Emerging Markets Ops. Yeah, all of these, they're actively managed funds. So, and you already know how we feel about that. So, no, I'd rather see you use the free portfolio we give you at Talking Real Money. One U.S., one international, one bond fund. Do the right mix, get on with your life. No, I would do that instead. Yeah, I would too. This just seems really gimmicky, and I worry about. And that's a legit worry on my behalf. The risk profile for a target date fund, it has a very high volatility ratio. No, this is silly. Gosh, Fidelity.
Because this is their roots. This is what they're going to continue to do, and I do not.
Yeah, but you know what?
Changing.
They got an advisor giving. If this is an RIA, giving this advice, I would argue that this is someone who's not acting in the client's best interest, given the expense ratio.
Because you could get the same thing for a quarter of the cost.
Yeah, you could.
Yeah,
at least half the cost.
I've got to go here pretty quick because I got to get back to one of my vacations that you interrupted here. So if you don't mind.
Okay.
So,
yeah. No, we're good. Leaving on a jet plane. All right. If you have questions, go to talkingrealmoney.com. Send them in there on the contact form. Or every Saturday, give us a call when we do our radio show that becomes a podcast. It's Saturday, 3 to 5 Eastern, 855-935-TALK is the phone number. And if you want to meet with one of our advisors, other than the guy who's on vacation all the time, just go to talkingrealmoney.com and click on the button that says Meet an Advisor, and we won't harass you. And it's free, and it
helps. The number of people have told us thank you for helping me figure all of this out.
And for those of you who think, this must be a gimmick, guys, we've been doing this for like this show, which is we've done others. We've been doing this thing for like, what do we do? How many years have we been doing this show? 15 years?
Yeah, 15, yeah.
And we haven't had a single person call and say, oh, that was just a high-pressure sales pitch. No, it's not. So, thanks for being there. Tell your friends. Enjoy your day, your week, your month, your year, your life. Go spend 6 minutes doing something productive instead of picking stocks. And we'll talk to you again on this podcast that does what it says. It's talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor. Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services. Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.